3 weeks ago, oil was at $68 a barrel. This week, it hit $160. That's a 70% move in 21 days. One of the fastest sustained oil spikes in modern market history. And I want to show you something, because the signal that caused this was sitting in plain sight weeks before anyone was talking about it. More importantly, oil has pulled back to $96 today. And the question everyone is asking right now is the move over? I don't think so, and I'm gonna show you exactly why, using the framework that flagged this before it happened. So stick with me. So let's set the scene quickly. The Strait of Hormuz is the narrow waterway between Iran and Oman. About 20% of the world's entire oil supply moves through it. Every day, supertankers, LNG carriers, crude exports from Saudi Arabia, Iraq, Kuwait, the UAE, all of it flows through a channel that's less than 40 kilometers wide at its narrowest point. So following the Iran escalation, maritime traffic through the straits dropped over 90%. Not slowed, not disrupted, 90% gone. And when that happened, oil wasn't at 68 anymore for long. So what followed was one of the most aggressive repricing events in the energy market in years. 68 to 117 in just 3 weeks. Straight up, almost no pause. And here's what makes this interesting from a market structure standpoint. The IVT framework have been flagging this accumulation in oil for weeks before the breakout. While the price was going nowhere, the signal was loading. This is crude oil on the 4-hour time frame through the institutional volume terminal Cantillon regime. Look at the lower panel here, the divergence readings going all the way back through January and into February. You can see these strong deviations, signals stacking up, one after another, while price was flat, ranging between $60 and $68. The framework was showing strong divergence, meaning the underlying flow didn't match the price action. Institutions were accumulating quietly while the price looked like it was going nowhere. That's exactly what divergence is supposed to catch. The price tells one story, the volume and the flow tell another. And when those two things disagree for long enough, something eventually gives. In this case, what gave was the Hormuz closure. That was the catalyst. But the accumulation that was already in place before anyone knew the catalyst was coming. That's the point. You don't trade the news, you read the setup. And you let the news do the work. From late January through February the 18th, there was at least 5 strong deviation signals on this chart. Every single one of them was pointing in the same direction. So where does that leave us today? Oil is now at 99.30. It peaked at 160 earlier this week and has pulled back roughly 17% from the high. On the surface, that looks like a reversal. But look at the framework reading. The VWAP deviation is almost 22%. That means oil is trading nearly 22% above institutional cost basis, above where the bulk of institutional positioning entered this swing. That's extended, and in a normal market, you'd expect mean reversion from a reading like that. But this is not a normal market, and the Hormuz closure is not a normal catalyst. The key question isn't whether oil is extended, because it is. The question is whether the supply disruption is structural or temporary. If the straits stay closed or even partially restricted, a $96 isn't just a pullback, it's the new floor. The swing age on this chart is 366 bars. This is a very mature bull swing with real institutional weight behind it. The volume compression reading shows 60% expanded volume. This move was confirmed by participation, not just price. And the transition signal is reading towards stable. which suggests that violent part of the move may be settling into a new range rather than collapsing. The bias is bullish and the framework, it hasn't flipped yet. So here's why this matters beyond just oil traders. Oil at 95 plus feeds directly into what? Into inflation, gas prices, shipping costs, manufacturing inputs, food and transport. Everything that runs on energy gets more expensive. CPI was already at 2.4 before this move. Add a sustained oil shock, and you're looking at a trajectory that makes the Fed's job significantly harder. We talked in Thursday's video about stagflation, the scenario where inflation goes up and growth slows at the same time. Oil staying elevated is the fuel that keeps that thesis alive, literally. The Fed meets Tuesday. They were already paralyzed before oil hit $116. They're not cutting into this. They're not hiking into a growth slowdown. They're going to sit there, choose their words very carefully, and hope the market doesn't punish them for it. And the bond market already knows this. That's why TLT is still weak. That's why gold is at 5,021. The flow is telling you clearly that the market is not pricing a quick resolution. Okay, so 3 things to monitor from here. First, the 88 level on oil. That's the line I want to hold if you're watching for whether the bull structure is still intact. A break below 88 on a daily close would suggest the spike was more event-driven than structural, and that the market is pricing the Hormuz situation as temporary. Above 88, the thesis hold. Second, the confluence score. Right now it's at 1. I want to see it reload to 3 or above before I'd consider this a high conviction long setup. The compression needs to rebuild after a move this large. Third, the Fed's language on Tuesday. If they acknowledge energy prices as an inflation risk in their statement, that's confirmation that stagflation narrative is entering official discourse. So what's the TLT's reaction in the 30 minutes after the decision? That will tell you more than the decision itself. Oil is not the only story right now, but it might be the most important one because everything else, inflation, the Fed, gold, bonds, has oil underneath it. A quick note before you go. The full framework, the IVT readings, the VWAP levels, the confluence scores, and the complete macro setup going into the Fed week is all in the members area at cantillonresearch.com. Today's brief is free. Link is in the description. If this kind of analysis is useful to you, subscribe and like this video. It really helps a lot. And I'll be back Tuesday after the Fed's decision with the full breakdown of what the language actually means. So see you then and trade safe. Bye bye.